Hey there! Do you remember the accrual concept? Let's refresh our memories. The accrual concept states that expenses must be recorded only when incurred and income must be recorded only when earned and not necessarily when cash is exchanged. Let me explain using this illustration. Kari Suits is a company that buys fabrics and uses them in the production of suits. Mr. Kari gets these fabrics from his suppliers for the sum of 100,000 naira without paying immediately. We call that a credit purchase. The accrual concept states that even though the cash has not been exchanged, Mr. Kari should recognize the expense because the fabrics have been delivered to him already. He will record this as an expense in the profit or loss account for the year. The same happens when he sells the suits for 200,000 naira on credit to his customers. In this instance, the suits have been delivered to the customers, so we can say that he has earned the revenue even though cash has not been received. Therefore, he will recognize it as a revenue in his profit or loss account for the year. It will look like this on his profit or loss account. Revenue, which is a credit balance, will be 200,000 naira, and expense, which is a debit balance, will be 100,000 naira. You would agree with me that there should be a second entry to these transactions, right? This is the double entry principle. The second entry will be determined by the time cash is exchanged. For revenue, if cash is received within the year, then the cash account will increase. Remember, the cash account is a debit balance, so an increase will also be a debit entry. For the expense, if cash is paid within the year, the cash account will decrease. A reduction in the cash account will be a credit entry. There you go. Very easy. Now, what if these payments were not paid and received within 12 months accounting period? Mr. Kari will need to make adjustments for payments that would be received or paid after the year. This is where the adjusting entries are used. The adjusting entries are entries in the company's general ledger that occur at the end of an accounting period to record any unrecognized income or expenses for the year. The adjusting entries are divided into prepayment and accruals, which we'll be looking at in future lessons. You've learned the application of the accrual concept in a business and what gives rise to the adjusting entries. That will be all for this lesson.